In March, the Bank of Japan announced an interest rate hike, signaling the end of the era of negative interest rates. That is to say, among the major global economies, none continue to implement a negative interest rate policy. Why did Japan suddenly decide to increase the interest rates? Today, let's examine the topic from various perspectives. As usual, let's briefly review the history of the Bank of Japan's monetary policy. This goes back to the late 1980s when the Japanese economy was booming like crazy, with asset bubbles one after another. This won't do. Time to chill out, said BOJ, so they started to raise interest rates and tighten the policy. As a result, the Japanese economy entered what is known as the lost decade, and of course there were also the lost 2 decades, and lost 3 decades later. In order to break this long-standing stalemate of economic sluggishness, in 1999, BOJ made a big move and dropped the interest rate to 0. This was the pioneer of the global zero interest rate policy, with the purpose of fighting deflation and boosting the economy. Time flies and it's 2001, the Japanese economy still hasn't improved much, and the central bank came up with a new move, introducing quantitative easing for the first time, also known as QE, by buying Japan government bonds and other assets to increase the money supply in the market, reduce long-term interest rates, and stimulate the economy. The operation was quite unconventional at the time, but later, when the global financial crisis hit, other economies also followed suit. By 2013, Abenomics emerged out of nowhere, whoosh, shooting out 3 arrows at once. The first arrow, aggressive monetary policy. Large-scale asset purchases aim to increase investment and stimulate consumption. This arrow is also called QQE, that is quantitative and qualitative monetary easing, which was done through by purchasing government bonds and other financial assets, including corporate bond and ETF, etc. Second arrow, fiscal consolidation, increasing government spending, in order to stimulate demand and consumption. The third arrow, growth strategy, involves structural reforms across various sectors of the economy to enhance Japan's competitiveness and raise its potential growth rate. In January 2016, BOJ made another big move, introducing QQE with a negative interest rate, in order to achieve the price stability target of 2%. The policy framework is designed to pursue monetary easing along 3 dimensions: quantity, quality, and interest rate. Per the interest rate dimension, it will apply a negative interest rate of minus 0.1% to current accounts that financial institutions hold at the bank, marking Japan's official entry into the negative interest rate era. As we know, some bloggers often refer to negative interest rates as lending rates. Actually, it's not the case. At that time, Japan implemented a 3-tier system which divided the financial institutions' account balances into 3 levels, each applicable to different interest rates. First, the basic balance level refers to the balance held by financial institutions before QQE, applicable to a positive interest rate of 0.1%. Second, the macroeconomic balance level, such as required reserves, such as deposits increased in the central bank due to specific operations, etc., applicable to 0 interest rate. Third, the policy rate balance level, in addition to the first 2, such as excess reserves, applicable to negative interest rates. In fact, this part of the balance accounts for a small proportion. In September of the same year, the Bank of Japan also implemented a yield curve control, that is the YCC policy, by buying a large amount of Japanese government bonds to lower long-term interest rates, especially setting the target for the 10-year government bond yield close to 0, so that it can make more flexible adjustments, enhance the sustainability of monetary easing and achieve sustainable growth. Despite the Bank of Japan's strategic combo, the inflation rate has always been far below the 2% target for a long time. Many years later, according to data from the Cabinet Office of Japan, Japan's nominal GDP finally returned to pre-pandemic levels in 2023. By the way, let's take a look at inflation. Japan's inflation rate in March 2024 was 2.7%. This is a bit higher than the 2% target set by the Bank of Japan. In fact, Japan's inflation rate has been above the target for 2 consecutive years. Great job. Perhaps the rebound of household consumption shall be also related to this. Let's take a look at the labor market. The recent data in 24 shows that Japan's labor market unemployment rate is 2.6%. A historical analysis reveals that the data is quite positive. Of course, this is not only related to the improvement of Japan's economy, but is also closely related to their increasingly unfavorable population structure year by year. Given such a macro environment, the Japanese Trade Union Confederation, or Rengo, won a 5.28% wage increase in spring labor management wage negotiations of 2024, which is the highest increase in 30 years. By the way, this number not only exceeds market expectations but may also add fuel to inflation. Against the backdrop of economic improvement and inflation reaching the target, the Bank of Japan made a decision on March to announce the end of the negative interest rate policy that lasted for 8 years. The question is, why did the Bank of Japan decide an interest rate hike at this time? Let's briefly introduce the Taylor Rule. It is a formula proposed by American economist John Taylor in 1993, designed to help the Fed set the federal funds rate at a relatively reasonable level according to economic output and inflation. Soon the Taylor Rule became one of the most commonly used monetary policy utility and is also an important tool for analyzing and forecasting the trend of the Fed fund rate. In fact, as the Fed, but also the European Central Bank, the Bank of Canada, the Bank of Canada, etc., consider it as one of the pivotal theoretical underpinnings for their monetary policy decisions. The Taylor Rule formula can be explained by a simple equation, like this. The nominal interest rate equals the natural rate of interest plus inflation, plus alpha times the inflation gap, plus beta times the output gap. It can be seen that two main factors are considered. The first is the inflation gap, and the second is the output gap. In fact, there is also a natural rate of interest inside, which is the interest rate that supports the economy at full employment and constant inflation. This is actually a more complex thing and is unobservable. It can only be estimated through mathematical model, so it won't be discussed here. The inflation gap is the difference between the actual inflation rate and the target inflation rate. The output gap, as the name suggests, is the difference between actual output and potential output. That is, the difference between GDP growth and potential GDP growth. In the above formula, the coefficients alpha and beta are both positive. In fact, in the earliest version, Taylor set alpha and beta to 0.5 based on data from 1987 to 1992. But different policymakers will adjust the coefficients according to actual data. For example, Yellen set alpha and beta to 0.5 and 1 during her tenure. This new expression is also the famous balanced method rule. In fact, there are many variants of the Taylor formula, but we won't talk about more details here. It is clear that if the output gap is positive, it means that the economy may be overheating. If the inflation rate is also higher than the inflation target, that is, the inflation gap is also positive, then the nominal interest rate should be raised accordingly, right? Japan's inflation rate has long exceeded the central bank's target, and the output gap has just returned to positive. So this time the Bank of Japan's interest rate hike is also reasonable from the perspective of the Taylor Rule. To be honest, although the Bank of Japan is determined to raise interest rates this time, the increase is only marginal, 10 basis points. That is, the uncollateralized overnight call rate was raised to about 0 to 0.1%. The report also specifically stated that to achieve this goal, the interest rate for the current account balance other than the required reserve was set at 0.1%. Do you still remember the three-tier system in the last interest rate cut policy? The second tier includes the statutory reserve at a zero interest rate, and the third tier is a negative interest rate. That means that the central bank deposit interest rate, including excess reserves, will be changed from minus 0.1% to 0.1% at once. Let's briefly talk about how the Bank of Japan's policy affects the uncollateralized overnight call rate. The overnight call rate can be regarded as the ultra-short-term funding cost for banks, and its changes gradually transmit and affect various term interest rates. The required reserves are the cash that financial institutions must deposit in the central bank at a certain ratio in order to meet central bank requirements. And the excess reserves, as the name suggests, are bank reserves beyond the requirements. We can simply and crudely regard it as a kind of deposit that banks put into the central bank. When the interest rate on excess reserves is lowered from a positive to a negative rate, It implies an increase in the cost of commercial banks' deposits, prompting banks to reduce deposits and allocate funds elsewhere. Consequently, this increases the supply of funds in the interbank market, leading to a decrease in the overnight call rate. Conversely, raising the rate on excess reserves from negative to positive means a reduction in the cost of commercial banks' deposits, ultimately resulting in an increase in the overnight call rate. From this chart, it is also very clear to observe the trend of the overnight call rate over the years, from rate cuts to rate hikes. Of course, the above is a simplified story, and the actual process is much more complex. Additionally, one of the reasons for the modest rate hike this time may be that the output gap has just turned positive. This rate hike is merely a precautionary measure, and whether further rate hikes can be sustained remains to be seen based on subsequent data. Apart from the small magnitude, they also did not confidently promise a complete exit from accommodative monetary policy, so we believe that this move is less about a rate hike and more about primarily exiting yield curve control, while also gradually and systematically unwinding quantitative and qualitative easing. By now, I believe we all have some understanding of the economic situation within Japan. Let's broaden our perspective a bit and take a look at the global macroeconomic landscape. It is well known that Japan is relatively resource scarce and has traditionally been a major importer of resources. Therefore, any slight changes in the prices of commodities on the international market can significantly affect Japan. However, this time it's quite interesting because the commodity index has fallen considerably compared to 2022. Looking at the annual report from the Japan Statistics Bureau in 2023, it turns out that energy prices have indeed declined, while foods and furniture have significantly driven up inflation. This implies that even if international commodity prices declines, it is likely that inflation in Japan will not fall easily. Additionally, Japan has historically been an export-driven nation, and shifts in the global trade landscape can substantially impact its export performance. According to the World Trade Organization, the volume of global merchandise trade fell by 1.2% in 2023. Moreover, regional conflicts and geopolitical tensions continue to cast a shadow of uncertainty over global trade. Yet, it's intriguing that despite these challenges, Japan's exports have continued to rise without any significant disruptions in 2023. Furthermore, adjustments in the monetary policy by the Federal Reserve have a significant impact on global markets, including Japan. Recently, the Federal Reserve has maintained the target range for the federal funds rate at a relatively high level, keep managing market expectations, and continue to reduce its holdings of securities. This could be one of the reasons why the Bank of Japan announced an interest rate hike this time, but was cautious about declaring an exit from its easy monetary policy stance. So the shift in the Bank of Japan's policy is both to alleviate domestic inflationary pressures and to keep pace with the trend of normalization of global monetary policy. The Bank of Japan's announcement also said that this policy adjustment was decided after carefully assessing the virtuous cycle between wages and prices. To be honest, I am envious of the fact that the increase in wages exceeds the inflation rate. Upon hearing about an interest rate hike, some people's immediate reaction might be that they can earn more interest by saving in the bank. However, the most significant impact of an interest rate hike is that it raises the cost of borrowing, which in turn affects consumers' purchasing power and the financing costs for businesses. Higher interest rates will naturally cool down the real estate market, and for consumers, the increased monthly payments on mortgages and auto loans mean a noticeable reduction in monthly disposable income for families. As a result, daily consumption activities will become less active. When aggregated at the national level, this means a decrease in the total demand for consumption in society. If we look at it through the lens of the aggregated demand aggregated supply model, or the ADAS model in macroeconomics, this is the process of the demand curve shifting to the left. But this is not the key point of today's video, so we won't delve into the details. For businesses, an interest rate hike increases financing costs, which clearly adds to their burden. Additionally, an interest rate hike can also lead to a corresponding increase in the returns on long-term bonds and fixed income investments, making some business projects economically unfeasible. This directly affects the investment decisions of business owners or other investors in the future. Just think about it. If a AAA bond can give you a 3% return, would you still take the risk to invest in a project that will earn 5%? In terms of the ISLM model in macroeconomics, this is the process of the investment saving curve, or the IS curve, shifting to the left. Of course, we won't discuss the details of this model here. Let's save that for another video. Some guys may wonder, given that the interest rate hike is as minor as a drop in the bucket, what impact could it have? I would say, we mustn't look at the surface. An interest rate hike is not a one-time event. The impact will gradually emerge. We need to wait and see if the subsequent policies can be sustained and for how long. I suddenly remembered the Bank of Japan is not the first time to play the interest rate hike game. Let's look through the history. Time goes back to the 1980s. After the Plaza Accord, Japan's economic growth was great. But in order to cool down the economy more, the Bank of Japan raised the official discount rate from 2.5 all the way to 6%. The result? The Japanese economy fell into what is often referred to as the lost decades. In August 2000, the Bank of Japan raised the overnight call rate from 0% to 0.25%. But just 7 months later, the Bank of Japan had to lower the rate back to 0.15%. In 2006, the Bank of Japan attempted a normalization of monetary policy. This rate hike was primarily aimed at cooling down the real estate bubble in first-tier cities that had been inflated by the previous QE policies. This hike lasted for 27 months, only coming to an end in September 2008. In my point of view, this rate hike did not curb the rise in housing prices in first-tier cities. However, more awkwardly during this period, the U.S. Supreme crisis erupted, triggering a global economic earthquake, and thus the Bank of Japan's rate hike efforts ended abruptly. It seems that none of the rate hikes have yielded positive outcomes. I wonder if this time will be an exception. It's often observed that some social media influencers clamor online, claiming that Japan's debt has gone through the roof, noting that the total debt has surpassed twice the size of its GDP, not twice the government's revenue, but twice the GDP indeed. They further conclude that with a rate hike, the interest on the debt might directly exceed the government's fiscal revenue, suggesting that the Japanese government would soon be unable to pay its debt. However, my understanding is that it is not as dire. First, Japan's interest rates are not so high, and they have been even lower in the past. Second, the Bank of Japan has not yet exited QE, which means they can employ various maneuvers, such as continuing to issue government bonds that their central bank purchases, to continuously borrow new money to repay old debts. Therefore, at least for now, domestic currency debt cannot be considered a big trouble. The Japanese government's real concern should be its foreign currency debt, but I haven't found the data, so I can't present it to you guys. From the historical balance sheet provided by the Ministry of Finance of Japan, it is found that Japanese government bonds and treasury bills together account for about 85% of the liabilities. And at the same time, we also find that a portion of the government bonds and treasury bills are actually held by overseas. Referring to this chart, 15% is a good number. Roughly estimated, overseas held debt does not exceed 12.8% of the liabilities. Therefore, I believe that the debt issue is not so severe. A brief summary. Japan's inflation over the past year is mainly caused by domestic consumption, unrelated to global commodities, especially energy. And the great wage increase in Japanese spring offensive for wage negotiations will further raise the household consumption levels. Currently, Japan's savings rate is also relatively low, indicating that Japan is reducing its savings rate and continuing to move towards a consumption-oriented economy. A few decades ago, the United States supported Japan to struggle with the Soviet Union, and the recent series of events show that the China-US trade conflict will not be eased for a while. So the Japanese economy has got its second wind, akin to a reincarnation. Furthermore, the Bank of Japan still maintains a cautious stance. As long as it adheres to the basic policy of continued easing, this minor interest rate hike is more about aligning with the Federal Reserve's policies than about alleviating inflationary pressures. Time flies, and that's a wrap for today's video. Hope you guys enjoyed it. If you think our videos are pretty cool, please do me a favor to hitting the subscribe button. We'll catch you in the next video. Thanks for watching.